Toto, it's time for you to get down. Well, get in the basket. Okay. Good boy, yes, good boy. Oh my goodness. You know, people are mistaking the most visible price for the most complete truth. But, honestly, the screen price is a leveraged liquidity price. Physical gold and physical silver are monetary and industrial assets with a much deeper demand base. Traders changed lanes. The metal users did not. So I want you to know that this is not about pretending that contract price does not matter. It matters because it's the loudest voice in the room. But like the Wizard of Oz, the loudest voice is not always the real source of power. So to understand why gold and silver are falling on the screen or volatile on the screen, we have to pull back that curtain and look at the mechanism behind the price. Because behind the curtain are leverage contracts, liquidity flows, margin pressure, risk on rotation, and capital chasing the next speculative story. But frankly, once we pull back the curtain, we see something important. And I tell you this all the time. Those gold users, those 33 different global gold users, did not disappear, nor did the silver users. The debt did not disappear, and the currency problem did not disappear, regardless of what the spot markets say. So this is the question that I get all the time. Why are gold and silver falling? It was fun on the way up, not so fun on the way down. But everybody who owns gold or silver has been asking this question lately. I mean, you look at the screen, you see red, you see the spot price falling or rising, and something inside you say, oh God, did I get this wrong? Is the value disappearing? That, my friends, is the emotional trap. Because most people have been trained to believe that the screen price is the truth, the whole truth, and nothing but the truth. But today, I want to show you, and the truth, and I want to help you slow that reaction down. Because after all, how many times can you be lied to when you do not know the truth? So before we let fear make the decision for us, we need to ask a better question. Are gold and silver falling because their purpose has disappeared? Or are we watching a temporary contract market move being mistaken for permanent truth? Because the contract price, it's the loudest price, no doubt about it. And it flashes on every screen. And they don't say spot gold contract or spot silver contract. They say gold, they say silver. And it moves every second. It gets quoted on financial television as gold and silver. And it becomes the number people emotionally react to. And like I said, it's fun when it's going up. It's not so fun when it's coming down. But that is a trade. And loud does not always mean complete. In The Wizard of Oz, the wizard's voice was loud. It shook the room. It demanded attention. But that's what we're going to talk about today. We are not pretending the contract price does not matter. It does because you care about it. But we are going to pull back that curtain and ask what is actually moving this price. Because there are two markets that people often mistake. The one market is tied to central banks, factories, mints, refineries, solar panels, electronics, defense system, jewelry, private savings, and long-term wealth protection. The other is tied to contracts and promises and are all counterparty risk. And when people collapse these two markets into one, they become vulnerable to fear. So this is the heart of the presentation. One market trades in one place and the other trades in the other. So let's take a look at those. Because in the physical world, that market trades everywhere. So let's look at the contract market first, because this is where traders express options, hedge risk, chase momentum, use leverage, meet margin calls, and move in herds. It is not evil. Well, maybe it's a little evil. But it is not completely irrelevant. However, you really do need to see what's going. Toto. Oh, Toto's cousin. But this is where. So let's just take a look at it because it's not the same as physical ownership. A contract can represent gold or silver exposure without requiring the trader to ever frankly touch gold or silver. And you know me, if you don't hold it, you don't own it. I like it in physical form. And that means that the contract price can be pushed around by forces that have very little to do with whether physical users still need the metal or not. This is the first part of the curtain. So let me show you the birth of it. Because after the dollar was cut loose from gold, gold became more and more financialized. We've talked about it, turned it into a financial product. It moved from being the monetary anchor behind the system to becoming a trade, a screen price, a futures contract, a financial instrument. That changed how people experienced gold. What you're looking at here is when they established in the 70s the spot gold contract. And what did they say about that? The impact of U.S. ownership will be the formation of a sizable gold futures market, but rather small demand for physical holding of gold. So when we went into that debt-based system, they started to take the gold out of the system. It's still at the base. Central banks absolutely still buy it. But the price became the story. And this is where the wizard's voice got louder, to where people began forgetting to look behind the curtain. This might be, I don't know, one of the most important slides in the presentation, because in 1993, the great Sir Alan Greenspan, some of you are familiar with him, I hope everybody is, because he was the Fed chair for a very long time. And he was discussing market psychology and inflation expectations and the role of gold as a signal. And he talked about watching the bond market, the exchange markets, and gold as signs of what the market was feeling. Then he raised a question. What would happen if the Treasury sold some gold and the gold price broke? And his point was extraordinary. The gold price would no longer be only a thermometer of what's happening. It would affect the psychology itself. This is the Wizard of Oz moment. And frankly, Alan Greenspan was an amazing wizard. That loud voice on the screen is not just telling people what to think. It can shape how they feel. That's that perception management that we talk about all the time. Because once people have been trained to believe the screen price is the whole truth, then moving that screen price can move their confidence, their fear, their behavior. And that's why this distinction matters so much and why I talk about it all the time. That contract price, well, that may be loud, it may be powerful, but it's not the entire market. Now, let's just step away from the thermometer and look at the patient, the physical market, because they understand that gold's price was not just a measurement, that it was a psychological signal. And that means that the screen price is not just reporting emotion, It can create that emotion. But in the physical market, well, that has to be mined, refined, transported, vaulted, fabricated, delivered, held. Oh my goodness, so inconvenient. Give me that inconvenience, I'll take it. But it exists in the real world, and the people who use it, well, they're not traders, at least not all traders. They're central banks and nations and manufacturers and energy systems and medical companies and technology companies and investors and families and savers and on and on and on. So the physical market is not just a chart, it's a global web of need. And that need does not disappear just because the loudest price on the screen temporarily falls. Now, we know we've talked about this. Silver is not just a precious metal. It is a fuse. It is an indicator. It carries energy and it conducts electricity, and it sits right inside the technologies people now call the future. Solar, electronics, medical uses, defense systems, batteries, contacts, circuits, industrial applications. And unlike gold, much of the silver used by industry is consumed, dispersed, or made uneconomically. It's just not economic to recover it. So when people look at a falling silver contract and say, silver must not matter anymore, they're missing the physical reality, and that's what I don't want you to miss. The screen is moving. The world is still plugged in. And silver demand, poof? No. Take a look at this. This slide matters because it shows that the physical silver story did not vanish. Demand is not only still there, but it's growing. And so are the deficits. They're still part of this discussion. Industrial use is still part of the discussion and the build out of all of this AI infrastructure. And investment demand, frankly, that's still part of the discussion too. So when the contract price falls, the question should not be, did silver stop mattering? The better question is, did the physical silver market disappear? What's the answer? No. Did the industrial users walk away? No. Did the world stop electrifying? No. Then maybe, just maybe, the price move is telling us more about traders than about silver itself. Now, I know that gold is the world's anchor, and it plays a different role. So where silver is the fuse, gold is the anchor. And it's not primarily about electricity or technology. Gold, it's more about trust. It's about reserves, wealth, settlement, sovereignty, insurance, memory. Gold has been trusted across cultures, across borders, across wars, across currencies, and across political systems. That's one reason, a big reason, why central banks not only still hold it, but are vastly accumulating it. And that's why families still save it. That's why I save it. People can run back to gold when they stop trusting promises. And we're close to that. I've been showing you how those confidence levels are falling. The contract price, well, that can move. But gold's role as an anchor is so much deeper than one trading cycle. So let's talk about the obvious question, because frankly, you know all the uses of gold and silver. And if gold is really losing its monetary purpose, like they want you to believe this time is different, did central banks stop buying it? Nope. Central banks understand something that many retail investors forget. Gold is not someone else's liability. It is not a promise from a company or a bond from a government, and it's not just a digital entry. It's not a digital entry that depends on confidence in a system. Gold is held because when trust gets thin, gold stands firm. So when the screen tries to scare people out of gold, remember this, please. I'm getting chills. The largest monetary institutions in the world are not confused about what gold is. Take a look. They're not going away. They're buying more and more. So take a look at the debt. Is that going away? And is that even the whole picture? Do you think that debt is going to disappear? Because the answer is no, it isn't. Now, this is one of the most important points that I really want you to make, because fear makes people focus on the last price tick. But wisdom asks, what changed in the foundation? Did the debt burden go away? Did governments suddenly become disciplined? Did the system become less dependent on borrowing? Because you're looking at a screen with the M2 money supply. And the more of this garbage that they print or just push a button and creates, the less value that everything else out there has, until it has zero purchasing power value at all. So if the debt problem is still here, then the monetary reason for owning gold, frankly, it didn't disappear. The chart fell, big deal. But the reason did not. And look at this money printing. Did that stop? Clearly not. The number of currency units, because that's really what it is. It's not money, it's currency units in the system, has expanded massively. And, winners and losers are chosen. Do you think it's an accident or that there's real value in the $1 trillion of Elon Musk's SpaceX and minting all of these brand new millionaires? Well, Wall Street has a printing press too. And right now that may not matter. But quite honestly, what does matter is gold and silver, because they are not just commodities, they're also measuring sticks. Everything used to be valued in terms of gold and silver, but once they took that out of the system, now everything's measured against a measuring stick, the dollar, that is going away and constantly changing. Because when more currency units are created, people can temporarily forget what that means, especially during speculative booms. Look at this. How many millionaires, trillionaires are being created? Look at all this wealth that's being created from nothing. But eventually, the question returns. What is the currency actually worth? This is why the screen price can be emotionally misleading. A temporary sell-off can make people feel poorer mentally, right? Oh my God, it dropped. Oh, that's awful. But the long-term currency story, well, that's telling you a very different truth. Did fiat money gain purchasing power during this time? Nope. This is where the story becomes personal, because this is not just about charts. It's about groceries, insurance, housing, medical bills, education, rent, and dare I say it, the cost of living. We feel this. The public feels this. They know their dollars do not stretch like they used to. So when somebody says gold and silver are falling because the contract price is down, I task you to ask a deeper question. Down compared to what? Compared to a currency gaining strain? Is it really the prices going up? Because that's how they pitch it to you. Oh, those prices are going up. It's really the currency going down. That is why it is so important that we see what's really behind the curtain. Because now, well, we come to a mechanism. Gold and silver rose sharply because money flowed into the trade. We talked about that. That does not mean that every buyer was thinking about physical demand like we saw when it was created, the spot markets were created. I mean, some were, clearly you and I were, but many, what were they doing? They were chasing momentum. Remember, straight up. And everybody's going, whoa, whoa, whoa. You can never count on Wall Street to give you true price discovery. That is behind the curtain. They saw the trade working in momentum, so traders piled in. They moved all that money, all that liquidity from the government, from the central bank money printing press. They moved it from one area to the other, and beginning of the year, they moved it toward the spot gold contract. That's how modern markets behave. When money flows into a lane, the price rises. When the lane gets crowded, it can do it very quickly, actually. But here's the part that people forget. The same kind of money that rushes in can also rush out. So can you see the pattern up and down? The wizard's voice can boom in both directions. Let me show you what I mean. And I really want you to pay attention to this pattern. And let's see if we can find this someplace else. This is the spot silver contract. Does that look like the same pattern? This is not unusual in financialized markets. Once traders see a pattern break, they do not always ask, well, what is the long-term physical demand for silver? Or even the shorter-term physical demand for silver. They ask, where is my stop? Where am I getting out? Where is the next trade? Where is the liquidity moving now? That is why people who own physical metal need to understand that they're really just looking at a trading mechanism. This is really, trading is how banks make most of their money these days, not in lending. And this chart, well, take a look at this. It does not prove that, the silver chart does not prove that it's lost its usefulness. It's just a trade. Now let's look at the gold market. Same idea. Gold had powerful moves, then the contract market weakened. But again, ask the deeper question. Did gold stop being an anchor? Did central banks stop buying it, accumulating? No. Did debt disappear? Did the currency regain purchasing power? No. So the chart is giving us information, but not the whole truth. The mistake is not looking at the chart. The mistake is letting the chart erase everything else that you know. The same flow of funds that pushes the metals up can push them down just as violently. This is the curtain being pulled back. The same flow of funds. Can you see that? Is it obvious to you yet? Because that's the mechanism. And it's really not a grand mystery. Sometimes it's leverage or margin or traders taking profits, or it's capital rotating toward a hotter story. Sometimes it's fear or it's greed. But the important point is this. A violent move in the contract price does not automatically mean a violent change in physical reality. Because, look, everyone gets this headline. Rates, the dollar, risk on, risk off, ETF flows, profit taking, margin calls, tech momentum, and of course, the mega IPOs. The headlines change, but the mechanism is the same. Liquidity moves. That's what markets do. They create a reason after the flow has already started. And this is where investors get emotionally manipulated. Not always because someone lies, but because the explanation arrives wrapped in authority. I mean, it's Wall Street. We're watching these. Somehow, the public believes Wall Street. I worked inside the belly of the beast. I know enough. I don't believe them. I dig deeper. But that voice is loud. The curtain shakes, and people forget to ask, what's behind it? Now, frankly, this might just be the most important slide because you've got to understand that gold users did not go away. Silver users did not go away. The traders simply changed lanes. That sentence separates fear from understanding. And that's really what I'm trying to give you today. Because again, how many times can you be lied to when you do not know the truth? The physical world did not vanish. The monetary problems did not vanish. Industrial use, that didn't vanish either. We certainly saw that the debt is still there. The loss of purchasing power is speeding up. What changed? How about the flow of speculative money? And you see, once you see that, then that emotional spell, boom, it begins to break. You stop asking, why is gold and silver over? Or why is it down? What is going on? Is this awful? But you start asking, where did the traders go? And what are they chasing now? And let me take advantage of the mess that they left behind, because you understand that this is really an opportunity. And you take advantage of it. Of course, we've got to talk about SpaceX. This is one place, just one, but there's more mega IPOs that are coming out because they become liquidity magnets. When a huge news story enters the market, we've seen it. I mean, that's Wall Street's job, is just to create these stories so that capital, well, they want access. Institutions want allocations. Traders, they want the next big thing. But that doesn't mean that the old asset lost its purpose or its real value, nor does it mean that that asset suddenly became that much more valuable, up or down. It doesn't matter. It means that the market's attention has moved. And frankly, this is really how bubbles form. Money chases the news story. But the road everyone is chasing is not always the road that protects them. Because greed chases bubbles. Fear keeps people away from what will protect them. This is how wealth gets transferred. Those guys at the top, they know absolutely everything that I'm sitting here and telling you today. They know the truth. And they manipulate you to believing a lie. People buy excitement late. Then they sell protection early. They chase what feels good and they abandon what feels uncomfortable. But protection really, I mean, honestly, it rarely fails exciting when you need to buy it. Because what is it really? But it's insurance. And insurance feels boring until the storm comes. Gold and silver can feel frustrating. I know. You guys, I've been accumulating since 2002, and everybody, once you do something, boom, you want instant pudding. But this is not instant pudding. And that does not mean just because the spot price has dropped, that their purpose has disappeared. Actually, it means the opposite. And it also means, or at least it may mean, that people are being tested emotionally, perception management. And we've seen this before. When? Well, 2008 and the great financial crisis. In moments of liquidation, the most liquid prices, well, they can fall first because, again, margin calls and all those reasons that we talked about. So people sell what they can sell. Just to meet that margin call, they need to raise cash for this next big trade. And then the people that don't understand what's going on panic. But in physical markets, it shows up in terms of premiums, in coins, long-term monetary demand. Quite honestly, that behaves very, very differently from the screen. And that's one of the reasons why 2008 is a great example, because you can see that as spot gold and spot silver miners fell, the physical only market, the collectible market, that's the physical only market, that made this trend high. So sometimes the market screams one thing in the moment, but history, that's really what tells you the truth. The wizard's voice can shake the room, but it does not change what's happening. It does not change what gold and silver are and have been for thousands of years. So please, this is the message I want to leave you with. Do not confuse temporary contract liquidation with permanent monetary truth. A contract price can fall and a chart can scare you. You know, the headlines, that's all about pressuring you. A new bubble can distract the crowd, especially where we are in this trend cycle and all of the gambling. This is just a big casino. It's not investing on Wall Street. It is gambling. So I ask you to ask yourself, did the users disappear? Did the debt disappear? Did money printing stop? Did fiat regain its purchasing power? Did gold stop being an anchor? Did silver stop being the fuse? So today we pulled back the curtain. I hope that you saw that the price flashing on the screen is not the entire gold and silver story. It's the loudest price, the contract price. It can be pushed up easily or down easily by leverage, liquidity, headlines, fear, and greed. The deeper reason for owning physical metals, gold and silver, sound money, they've not disappeared. This is about your freedom. This is about your future. Just keep in mind, debt did not disappear. The loss of purchasing power didn't. The need for real assets, more important than ever. Industrial demand, well, that's going to fluctuate with the economy too. But the monetary role of gold is critically important. That's why you and I both own it. What changed was the flow of funds. Traders changed lanes. And that's why this moment is so important. The goal is not to react emotionally to the wizard's voice on the screen. The goal is to understand what is really and truly happening behind that curtain. And then make a calm, informed decision about your own wealth that puts your best interest first. That's what this show is all about. That's what Zang International is all about, education. So before you allow fear to push you away from protection or greed to pull you toward the next bubble, take the time and call us. build your sound money strategy that first takes into account your goals. What are you trying to accomplish? Because quite honestly, there's gold and then there's gold, and there's silver and then there's silver. Click that QR code on the screen and book an appointment with your sound money strategist. And let us help you look at your personal situation, your goals, your risks, and the truth, so that you can create a sound money foundation with clarity and not panic. Because quite honestly, temporary contract liquidation, counterparty risk should never, ever, ever be confused with permanent 1,000-year histories of monetary truth. And I do not think that this time is different. Do you? Oh, I guess that's it for today.
Lynette, we have a few reminders for our viewers.
Oh, I have some reminders. Oh, okay. Rickroll Symposium. I'm so excited. I mean, really, I love the work that I'm doing. And I love him. Boca Raton, July 6th through the 10th. Be there or be square. There are still virtual tickets available, but it is a packed house. And the Red Pill Expo in Las Vegas, July 11th through the 12th. So I'm going to have a very busy July, but be here and tell all your friends. Tell all your friends. G. Edward Griffin, who wrote and understands the Federal Reserve probably better than anybody else in the universe, will be here, and you get to ask him questions. So whatever comes to your mind, write it down and bring it. Next Tuesday at noon, Arizona time. And let's come together and, I don't know, how about we all just make a positive difference for a whole lot of people? So again, wherever you are in the world, let's make this a better place. Bye-bye.